Thank you all for joining us today. Hello and welcome to today's broadcast or webcast, A Brave New World, Strategies for Transfer Pricing Risk Management, Compliance and Mutual Agreement Procedures, with presenters from Eversheds International tax team. I introduced myself briefly. My name is Caroline Setleff. I'm a tax controversy and litigation partner in the U.S. tax practice, and I am joined by my esteemed colleagues from Germany, UK, and Italy. I'm going to turn it over to Gianluca to introduce himself, and then Giles will follow, and then we'll go to Lars, and then we'll get started. So Gianluca, please introduce yourself.
Thank you, Carol. I'm Gianluca Nemec, a principal associate of Eversheds Sutherland, Italy. I'm a tax lawyer based in the Rome office, and I've been dealing with transfer pricing matters for 15 years. And today I'll provide you with a brief overview on the tax audits on transfer pricing in Italy and with a very interesting case study. Thank you.
Hi, my name is Giles Salmond. I'm a UK tax partner and head of tax disputes in the Eversheds Sutherland UK office. And I will speak to you this afternoon or this morning in relation to the MAP procedures and some of the issues that we've seen, particularly in the Middle East.
Yeah, and hi, I'm Lars Haverkamp. I'm a tax partner in Germany in the Düsseldorf office. I focus my practice on international tax and transfer pricing. I've been doing this for more than 15 years now, and I'm happy to talk on this webinar on several topics together with my distinguished colleagues.
Thank you all. In terms of getting started, before we begin the program, I just wanted to note a few housekeeping notes. Today's program is approved for CPE credit in the United States and CLE credit in the following states: California, Georgia, New York, Nebraska, Pennsylvania, and Texas. CLE is pending in Illinois, Virginia, and Washington, so we'll keep you up to date on that front. If you would like to receive CLE credit and CPE credit, please complete the attendance sheet that was emailed to you and submit the form to the email address listed at the bottom of the page. We're going to put the link in the chat box at some point in the presentation. So if you didn't get the email, you'll have that. We will provide various confirmation codes for you to enter on your sign-in sheet. If you meet the criteria for the credit, your CLE and CPE certificate of attendance will be sent via email within approximately 30 days. And please note, today's program will be recorded and provided via email along with the presentation slides, and questions can be submitted in the Q&A box at the bottom of your screen. We're likely not going to have enough time to go through all of our robust slides, but we have provided the slides for your reference in case you would like to consult them in the future. So I think we can get started. We listed the key objectives here. I'm not going to repeat them, but hopefully we'll get through all of the materials. Emily, could you please move to the next slide? Thank you. So we could spend literally hours talking about pillars 1 and 2 and BEPS and everything that's happening. Right now, we're focused more on the status of dispute resolution mechanisms. I will note that, Pamela, if you want to move to the next slide, we put in some items here for you as reference, but in terms of pillars 1 and 2, on May 27th, the OECD released 2 public consultation documents regarding tax certainty framework for Amount A and the tax certainty for issues related to Amount A. And so there are a number of things that that were discussed, or that the OECD sought comments on: the scope of certainty review, an advanced certainty review process, and a comprehensive certainty review. The second consultation document that I mentioned really goes to asking access to dispute resolution, a mandatory binding dispute mechanism related to Amount A, and an alternative elective binding dispute resolution mechanism. So the OECD, I will mention, has posted comment or published comments received through July or June 10. And it's going to be interesting, Pamela, if you want to switch it to the next slide or so. I'm not going to go through all of these things, but it'll be interesting to see how countries are likely to dispute whether they're getting enough of the piece of the pie, so to speak. So we'll see what happens with pillars 1 and 2 in terms of dispute resolution. But I did want to mention that really the principal benefit of pillar 1 is to achieve certainty that comes with being able to achieve multilateral resolutions for disputes. Pamela, if you'd like to switch it over. And then we've outlined briefly, some of the anti-base erosion rules and model tree provisions. So we'll see what happens. I think, Lars, you're going to be discussing the next set of slides. So I'll turn it over to you and we'll continue. Lars?
I was on mute, sorry about that.
No worries, no worries.
Let's move to the next slide, please. Okay, perfect. So what we've realized, and Carol briefly touched on that. So we have the most important development in international tax, if we like, in the past, I don't know, 50 years with the BEPS projects and the transparency approach and global transparency measures implemented by the OECD, the European Union, which is a strong defender of the BEPS project. And what we see here is that effective tax audit management has become more and more important in the past. I mean, it was always important, and what we've here on that slide, it's probably not big news, but it's still important. I guess it's more important than ever. So what we've done, we've summarized the relevant steps one needs to take in a transfer pricing audit. So what needs to be looked at, what will happen, what are the different scenarios and different steps that one needs to take into consideration. And if you look at this slide, which is really a brief summary of what everyone probably knows, is there are 3 major slides, or you can actually split it in 3 different phases. One is the preparatory phase, if you like, the execution phase, and the post-audit phase. And we will focus on these phases in a bit today, especially on the post-audit phase, litigation and mutual agreement procedures, something that Giles will also refer to and talk to later on in this webinar. But what I would really like to talk and stress with you is the preparatory phase and the execution phase. Next slide, please. So why preparatory phase? So before audit is after audit, so to speak. That's something we would say in German, at least. And I think what is really often neglected or ignored is the phase before the audit. So everyone waits for the audit order to be passed on, and then people get moving, so to speak. But you have actually to prepare for this audit way before, especially today with the transparency approach in Europe, but also with Europe and the United States and so forth. So it has become more important to be prepared for this audit, because as you, or at least what we see here, is these tax audits become more and more aggressive, even though you might expect that it should be more cooperative. But my feeling is cooperation is something that needs to be done by the taxpayer and less by the tax authorities. So it is always good to be prepared, and that's something that I want to stress here even more. And I don't want to go through this whole slide. I think it's very, very easy for everyone to understand. It's just the main points, and I think it's not rocket science. But something that I really want to stress before every audit: go back, look at your master files, look at your local files for the previous audit, look at what needed to be changed, what has been discussed. Are there any adjustments? Did you follow up on any adjustments that were required by the IRS, or here in Europe by the tax authorities in the UK, Germany, or where have you? And what still needs to be done? Do you need to, make amendments to your intercompany contracts? Do you need to actually prepare contracts? I mean, that's all still possible in this preparatory phase. Is something you probably cannot do once the actual audit has started. So that is very important to look at that. This is actually the time where you can bring your house in order, if you like, and get things done before the actual audit starts. Possibly, and I mean, this is worst case scenario, maybe you want to disclose something that hasn't been disclosed before. So what I see in my practice, that there's always there's not much willingness to do this because it seems like a waste of time. But to be honest, even if you spend time here and money in this preparatory phase, it will actually pay out in the end. Because you can also, and that is also part on one of the next slides, you can also already prepare your strategy for the tax audit, and that is very important. One last point which I wanted to strike, which comes more often, is actually emails and business correspondence. That is something tax authorities tend to look at more closely. I had one case where the tax authorities in Germany requested 16,000 emails. So without artificial intelligence, you will not able to track and spot your weaknesses. But that is something you should actually be prepared to do at some point. Also, as it says on this particular slide, if possible, do interviews. If you can already identify weak spots in your transfer pricing documentation or in your intercompany transactions, interview people, and not only, you know, the tax department or the management, but actually talk to the guy in R&D, the guy in sales, you know, the people which actually do the day-to-day business, because that is something that we've seen the tax authorities more and more tend to do. They start to interview or try to interview actual people in operations. So that's really important. And then, of course, the CBCR, so the country by country reporting, that is actually easy to spot weaknesses in your value chain. So please take a look at that as well. Next slide, please. And then you come to your execution phase. That execution phase is the word that I would use for the time once the audit has started. Again, you know, be aware, what is your strategy? I think I cannot stress that enough. An audit is basically a negotiation. And as we all know from the Harvard concept, you should know your best alternative to a negotiated agreement. So that means from the very beginning, look at what you want to get to. And what I'm trying to say is, for example, you may be fine with VAT adjustment, but not transfer pricing adjustment. You may not, or the company may not mind transfer pricing adjustment as long as the policy is being accepted by the tax authorities on a global level. So it is very important at the very beginning, look at your specific business, look at your value chain, and then determine at least at the very beginning of the tax audit, where do you want to get to? What is your real objective? Of course, nobody wants to pay additional taxes, but sometimes it's more important to safeguard your transfer pricing system as a whole, or your policy, if you like, or certain policies, or, you know, safeguard a certain benchmark that you're using. And if you're clear on that from the very beginning, you can actually steer the audit in the right direction. And I think that is very important nowadays, with, you know, joint audits becoming, for example, more important in the European Union, where you're being audited at the same time in two countries by one team, by joint team, if you like. But also with the exchange of information between the different jurisdictions, it's very important that you are prepared for anything that will come. Another aspect, which, you know, wasn't really important when I started in transfer pricing 15 years ago, is the procedural side. So in the past, it was sort of like, it was more a topic of valuation, and then, you know, a bit of negotiation in the audit, and you could always reach an agreement with the tax authorities. I think the landscape has changed a lot here, not just in Germany, but I think in general in Europe, and I understand possibly also in the United States, that you have to prepare also from a procedural side. So be aware of what are your duties, but what are also your rights, your procedure rights in an audit. What do you need to disclose? Don't make the mistake of disclosing everything too eagerly. Wait, balance your duties and your rights, and only cooperate if you're required to. And always keep in mind, as I said before, your strategy. Next slide, please. So yeah, again, very important that we focus on these things. And one important factor, as I said before, why would you do all of this? You want to prepare your strategy. You want to be able to substantiate your strategy, meaning to defend whatever your goal is, and find, as I mentioned before, your best alternative to this strategy, if you like. So if you cannot get your number one goal, what would be your second goal, so that you're always flexible to move in this execution phase, and be aware of the possibility that, you know, information from other countries may be exchanged or provided to the tax authorities in the audited country, for example, in Germany, or in the US, or in the UK, or in Italy. So always be aware and act strategically. I think that is the point that I wanted to make. So with that, I want to hand over to Carol, who wants to give us a US perspective on these.
Thanks, Lars. No, I echo everything that you said. A lot of what you said translates very well into what we're seeing here in the US. I will say, in terms of adding to what you said, the functional interviews is an area that we are seeing cross-border that's very important for the tax authorities. They're comparing the documents, the intercompany agreements, and whatever else, and they're matching those up with the functional interviews that are conducted to see if there's any mismatch between the activities that are said to be happening and the actual activities that are happening on the day-to-day basis. And in my practice, they have the taxing authorities have gone so far as looked at LinkedIn profiles. They've looked at job descriptions on various websites that are published. They've asked the company for the job descriptions that were existing at the time those job descriptions were put in place. They've looked at changes over time from those job descriptions. So there's a lot of movement and there's a lot of knowledge out there in terms of taxing authorities looking at websites, looking at everything they can to make sure that to see that there's some kind of mismatch between what's really happening. And so I echo what Lars said. The functional interviews are becoming much more prevalent, much more important in terms of really what's happening on the ground. And then privacy is another issue that I'm dealing with a lot. Various jurisdictions have very strict privacy rules. That's another area that we're also grappling with, along with privilege. The U.S. privilege doesn't extend across all jurisdictions, obviously, and so we're seeing a lot of situations where where we would claim privilege in the U.S. doesn't necessarily hold true in some of the jurisdictions that we're dealing with. And I will mention Australia is one where if you invoke the LPP privilege, you're pretty much disclosing everything that you wanted to stay privileged. The form that to claim privilege in Australia is very onerous. It asks you the time and day that you were given the information, what the information was. I mean, it's pretty egregious how it's set up. So I will say that if you're going to try to invoke privilege in other jurisdictions, you have to really understand what's entailed. Partner with a local. We typically will partner with someone local to really ask them what the rules are, because there are a lot of footfalls that you have to be aware of in terms of maintaining privilege. One of the attendees asked about, I see in the question and answer box, we have that situation where one of our clients hasn't had really great record keeping. So how do we handle that? What we've done is we have looked through paper files, or the client has looked through paper files, because not everything was electronic at a certain point in time. If there are paper files and you can try to trace through the history of why something was done a certain way, that's how we've handled it. There's a lot of movement in companies. We've reached out to former employees of the company in terms of trying to get a better understanding of what was done, why it was done. We've conducted our own mini interviews. I mean, there's ways around it. I will say that the document retention policies are extremely important to have, because you don't want to be in a situation if you have a destruction policy, let's say after a year, and you can't get those documents, online documents, that does become problematic. So we work with companies to make sure that whatever policies they have in place really makes sense in today's brave new world of information exchange and transfer pricing. So with that, sorry.
Yeah, I just wanted to mention with the,
yes,
if you're unable to retrieve the documents and you are still within, the required time frame where you actually had to keep them 10 years, whatever it is in your jurisdiction, that may actually be an issue and may lead in some countries to the tax of, to actually lowering the burden of proof, so to speak. So making it easy for the tax authorities to apply estimates to your particular case. So what you would need to negotiate on a, let's say, one-on-one level with the tax auditor is that you will provide whatever is available, and the other things will, you are, to put it in another form, you have to explain why you're not able to provide all this information. So that may actually be an issue. And then, as Carol said, maybe interviews might help or something along these lines. But of course, you're in a more defense position then. That is actually true. And what I wanted to say, with all the bulk of electronic information, I think there's good AI solutions, which I remember in my case back then, that there's actually an AI software, and don't ask me what the name was, which can go through all these emails and spot relevant information. That's what I wanted to add. Thanks.
Thanks, Lars. No, yeah, I agree. The fact that there is a lot of information out there. You want to make sure that you, for example, in one of the jurisdictions I'm working in, we have a protocol now. The client is under audit, hasn't gone in litigation yet, but what we've done is we've segregated a number of emails by a particular code or project name or whatever, so that we know that we have to be very careful with those particular emails, and the company understands they need to be very careful with those particular emails. Okay, so I think we could talk about this for hours, but since we don't have much time, we'll move on to the next slide. So, everybody, Pam, can you switch it over to the Coca-Cola case? So everyone knows about the Coca-Cola case at this point. I'm not going to spend a lot of time describing the facts because everyone could, read the case for themselves. But I will say that there are a number of things that are highlighted in the case, and 482 transfer pricing determinations, as everyone knows, grants the IRS broad discretion to distribute a portion or allocate gross income, deductions, credits, or allowances to prevent the evasion of taxes or to clearly reflect income. So the IRS's determination must be sustained absent an abuse of discretion. And as we all know, that's a very high level that has to be overcome. And so in transfer pricing cases, at least from the Coca-Cola case that we've seen, the 482 adjustment therefore has a dual burden. The taxpayer has a dual burden. First, the taxpayer has to show by clear and convincing evidence that that the IRS's proposed transfer pricing policy or adjustment is arbitrary, capricious, or unreasonable. And the taxpayer also has to show by a preponderance of the evidence, so that's greater than a 50% probability, that regarding the proper arm's length result. So what we've seen from the Coca-Cola case is, I guess, some points. Just because a taxing authority has agreed to the pricing associated with a specific transaction doesn't mean that they're going to do it again for the future. So it's important to look at your intercompany transfer pricing policies, Look at the arm's length standard annually. That's something that we work with clients closely on in making sure that not only their transfer pricing documentation is robust, but really, like I mentioned before, the functions, assets, risks, everything, all the analysis packaged together still hold. And also you have to look at external factors. Sometimes there are instances where your internal facts are the same, but there's certain external factors like industry changes, market demand shifting that will impact the arm's length standard. So that's another area where we look with clients just to make sure that there aren't any external factors that may impact the analysis. Pam, I think you can turn it to the next slide. Again, this is a lot of historical background on the Coca-Cola case. But I will say lessons learned, just look at your transfer pricing documentation and make sure that you have local counsel in various jurisdictions. I can't stress that enough. Here in the US, my eyes have been open to so many different ways that taxing authorities are aggressively looking at various things. So I will end it there, but I will give the first code. So the first code for CLE CPE credit for this section is EGGS, E-G-G-S, EGGS, E-G-G-S. So please note that to get CLE and CPE credit. Gianluca, I'm going to turn it over to you next to go through your slides, but we'll talk soon.
Thank you very much, Caroline. Okay, we can go to the next slide. Thank you. The tax audits here in Italy are usually carried out at the taxpayer premises. Also, due to the pandemic, in the recent years, they are often carried out directly at the tax office, exchanging all the relevant documentation by email. At the beginning of their activity, the tax inspectors generally deliver a list of documents to be prepared by the taxpayer, which is examined during the audit, and at the end of their activity, the tax inspector must draw up a final report whereby the outcome of the audit must be detailed and the findings, if any, must be explained and motivated. Then a specific department of the tax agency examines the findings and starts the assessment procedure, which may lead to the notification of a notice of assessment requesting the payment of higher taxes, interest, and penalties. Next slide, Pamela, please. When it comes to audit on transfer pricing, usually the tax inspectors request in advance a copy of the transfer pricing documentation, which is not a compulsory filing here in Italy under the Italian law. However, if it is duly prepared and consistent with the domestic requirements, the taxpayer is entitled to benefit from the so-called penalty protection regime, also from a criminal tax law perspective. So in case of tax adjustment, only the higher taxes are requested. The tax authorities may deny the penalty protection regime, despite of the structure of the documentation complies with the applicable provision, if the contents are incomplete and do not comply with the instruction, or the information provided does not correspond in whole or in part to the truth. So usually they provide the evaluation of the accuracy of the documentation directly in the final report. Tax authorities cannot deny the penalty protection regime if they do not agree with the transfer pricing methodology or with the benchmark study used by the taxpayer. So they can identify a different set of comparable companies, they can make an adjustment, but they cannot deny the penalty protection regime in these cases. Therefore, a very careful evaluation must be made in connection with the choice to prepare the transfer pricing documentation or not. Next slide, please. Okay, coming to the case study, we are assisting the Italian subsidiary of a multinational group operating in the trading of commodities sector, from the tax audit up to the tax litigation, which is currently in place. The Italian company prepared the transfer pricing documentation, but it did not report an operation that is an intra-group guarantee granted free of charge in favor of the parent company within multilateral revolving facility agreements concluded by the latter as borrower with a pool of banks. The tax inspectors discovered such transactions since it was explained in the minutes of the board of directors. So apart from the directors, within the company, nobody was aware of such guarantee, including the tax manager. And this was the reason why it was not reported in the transfer pricing documentation prepared by the company. Consequently, in the case at stake, tax authorities denied the validity of the transfer pricing documentation. Next slide, thank you. The first finding of the tax inspectors referred to the intra-group sales of goods, where the company applied the cap method by comparing the price applied to those provided by the CBOT, the Chicago Board of Trade, while the tax inspectors decided to apply a transactional net margin method by using the return on sale as profit level indicator. Substantially, they dispute the fact that the company documented just a portion of the intragroup sales and not all the transactions for euro around 150 million. By means of the second finding, remuneration of intragroup guarantee, the tax inspector stated that the guarantee related to the contractual obligation of the borrower for the availability of a credit line to be used to finance the activity of the subsidiaries should have been remunerated. So in the next slide, there is the outcome of the first level of tax court. Where with reference to the first finding, the tax court fully upheld the ground of appeal related to the sale of goods. Specifically, we have filed a report by means of which we have documented all the intragroup sales made by the company in accordance with the specific provision of the OECD guideline, transfer pricing guidelines, specifically Chapter 2, Paragraph 19, which provides for that under the cap method, the arm's length price for commodity transaction may be determined by reference to comparable uncontrolled transaction represented by the quoted price. So we have provided all the agreements, the intercompany agreements, all the CBOT price statement for each transaction, and the reports of third parties related to the market value of the premium that usually is added to the price of the commodities in this specific sector. Unfortunately, with reference to the guarantee, the tax court did not uphold our appeal, which was substantially based on the fact that the guarantee was granted to strengthen the position of the borrower before the banks, also in terms of lower cost of the loan, considering that through the cash pooling of the group, such money was made available with the same interest rate to the operating companies of the group, including the Italian subsidiary. The tax court in this case did not uphold the ground of the appeal, substantially recognizing that no specific transfer pricing analysis, including a benefit test, was done at the time of entering into force of the entire financial operation. So again, also in this case, the lesson learned here is that before entering in any intragroup transaction, the clients must perform a very careful analysis from a transfer pricing perspective. That's all from my side. There is the, for those of you wishing to seek CLE CPE credit, the passcode for this section is BACON, B-A-C-O-N, BACON, B-A-C-O-N. Thank you very much.
Thank you, Gianluca. Okay, so I briefly wanted to mention, business restructuring matter. We've been involved in several of these matters. It's just to highlight how aggressive the taxing authorities are becoming. And I will talk about the DPT, diverted profits tax, a bit later. But in terms of the business restructuring context, the ITA is looking at, it's terming business restructurings very broadly. It's looking at, various instances where license agreements are entered into, and they are challenging that on the basis that there was a functions, assets, risk transfer, also known as a FAR transfer. And we've seen a lot of cases in Israel where, there's the latest case, Mendengo, that followed after Broadcom, where the ITA has lost in its aggressive stance on how it looks at business restructurings. And what's interesting is the OECD has a chapter 9 on business restructurings, and the way the OECD looks at it is quite different than the way the ITA claims that, the ITA is claiming that it's looking at the OECD guidelines and applying the OECD guidelines. But if as a taxpayer and as a practitioner, if you match up what the OECD guidelines say with what the ITA is saying, you can see that there's definitely a mismatch between the different analyses. So essentially, I will mention that, like other taxing authorities, the ITA is looking at things from a very narrow point of view. They're looking at business restructuring as tantamount to a FAR, and they're challenging companies on that basis, when in fact there are 2 court decisions now that went against them. My view is that I don't think they're gonna back down anytime soon in terms of litigating these positions. The Broadcom case was not appealed, and the Mendengo case that the ITA lost, they currently extended their time in which to appeal that case. So it'll be interesting to see, now that there are 2 cases against them, what they're going to do in that respect. And then I will mention that Pamela, if you want to go to the next slide, there was another case where the ITA won, and they based their guidance largely as a result of the Jateco case. But as I described, there have been 2 cases that have come out since then. And, the way the OECD looks at business restructurings is very much a holistic, that's the best term we've been able to use for it. It is a holistic exercise where the OECD properly examines the contractual agreement at the outset and the intent of the parties, as it should, and looks at various factors in looking at the entire picture, whereas the ITA seems to just be focused on one particular aspect of what it's terming, business restructuring amounting to FAR. So it's very interesting to match up the OECD guidelines with, I guess the lesson learned here is just because a taxing authority tells you that it's a certain way under their law, you really have to look at the, if they're a member of the OECD, you really have to look at what the OECD has said. You have to look at what their law is really saying at the end of the day, and try to figure out ways to try to convince them that their position is wrong. So with that, I will turn it back to Lars.
Yeah, thanks, Carol. Next slide, please. So what we just, summarize here, still hot topic, so to speak. Restructuring is a very interesting factor. We just had the law on the transfer of business function, what we call it. It's the same as the FAR transfer, if you like, being changed here in Germany last year. Now we had new regulations, new ordinance draft ordinance from tax authorities on this. So I think this is always a hot topic. It's not on our list, but I think reorganization and business restructuring, that is always a big topic in tax audits. And obviously you need to be prepared and prepare proper documentation up front, but also be prepared strategically for your tax audit. But what I briefly want to mention is, DEMPI, obviously big thing, not just in Germany, anywhere. I think the tax authorities have introduced DEMPI proactively, even though it may not be in the law yet. We, at least in Germany, we've seen this in audits for years before DEMPI was actually introduced in our German tax law. Big thing, always a big topic, obviously interesting because of the license fees and the royalties and so forth, and the residual profit split, basically what we're looking at here. Very, very, very hot off the press, if you like, intercompany finance, intercompany loans, debt equity ratio, and debt equity or treatment or requalification of debt into equity. That is something that has come up, or it comes up more and more in tax audits in Europe and in Germany. And we will have, or we already have, a draft EU directive, the DEBRA directive, where the EU has identified that too many subsidiaries are financed through debt instead of equity, and that needs to be changed from a legislative perspective. So that is very important, will be introduced presumably in 2024, so there isn't much time. Something you should look at. Management service fees, as always, an evergreen. It's in every tax audit. And new one, matrix structures, PE structures, even though not new as a topic. I think due to COVID, we see this now very much. And it's the PE risks and the wage tax risks associated, but also the transfer pricing risks. And then last one, which is close to my heart, unstaffed permanent establishments. So we're talking about wind parks, very important nowadays, especially in Europe, where we want to move away from or would want to move to emission-free energy, but also data centers, where you have certain permanent establishments in a country, although you don't have any staff, or you actually have to hire a third-party staff or from another group company. There's a lot going on, especially here in Germany. We have many lower tax court cases which indicate that there is a shift. We actually have one case where the federal tax court has ruled, in Germany at least, that an unstaffed PE still, despite the OECD authorized OECD approach, and despite the fact that there is no personnel allocated to that permanent establishment, that this permanent establishment still generates income in Germany. And that is due to the fact that the legislator did something wrong in, passing the AOA into, or adopting the AOA into a national law. Long story short, these are things that you should actually watch out for. If you have something like that, please take a closer look before your next audit. And I think, Carrie, you wanted to talk about Australia, very interesting topic.
Yes, thank you. Now, Australia has been on my mind a lot lately. We're dealing with an issue where Australia is trying to assert a diverted profits tax. It's a relatively new regime in Australia. It was enacted in mid-2017. It largely follows the UK DPT, which was enacted, I believe, in 2015. Some of the provisions are different, but what we're trying to deal with at this point in time with Australia is trying to see if MAP procedures, mutual agreement procedures, are available in Australia if you have a DPT invoked. And the legislation in Australia, the domestic legislation, says that it's treaty proof. So what we've done is looked at UK, and UK recently, as of October of last year, we discovered that they are allowing a MAP to go through in their legislation, even though it's a UK DPT. They're not, interestingly, one would think if they're allowing a MAP procedure that somehow they're basically implicitly saying that it's a covered tax for purposes of the treaty, but that's not the case. We've discovered that it's what they're saying is you can go to MAP. We're not going to tell you not to go to MAP, but we're not saying it's a covered tax. So what we're trying to do here in Australia, we're trying to figure out what arguments we can make to say that we should be entitled to go to MAP, irrespective of the fact of how the Australians term DPT, because they say it's not an income tax, it's not a corporate tax, it's basically a penalty regime. But in operation, I mean, they can call it whatever they want, but in operation, it is acting like a layer of income tax, albeit at a much higher rate in our case, so that we're dealing with a royalty rate being much higher than what's allowed for under the treaty. So it's a very interesting situation where we're trying to parse through the various pieces of legislation, trying to make arguments based on what the UK has done. That's not to say Australia will accept what UK has done, but it is an interesting project for us to be dealing with. So in the interest of time, I think we'll move on. Lars, you're going to cover the next set.
Okay, thanks. So I'll speed up because we're running out of time, I suppose, and I really was looking forward to what Giles is going to say. So this is just for your reference, the statistics. So MAP is still a major issue in most developed countries, at least, but actually around the world, and it's picking up. Next slide, please. And I want to skip that. Obviously, the procedure is clear. First, tax authorities will try to resolve the problem unilaterally, and otherwise it will go to MAP. On this slide, you have it a little bit from a European perspective, where we have 3 different legal bases for a MAP proceeding. Here you have some comments and the statutory requirements to start a MAP. Next slide, please. You can tell I'm speeding up here. So the legal basis in Europe is basically, we have the new EU arbitration directive, which is fairly new, I think 2018. And we have the arbitration convention, which has been in place for a long time. Both focus only on European Union cases. The EU arbitration directive applies to any double tax situation, not just transfer pricing, whereas the arbitration convention, which is fairly established, focuses on transfer pricing exclusively. And then obviously we have double tax treaty MAP procedures, which is a little different. For example, we have this issue with double tax treaty where you only focus obviously on companies which have treaty protection under this treaty. And there is always the question with permanent establishments, where would we allocate them? Are we talking about headquarters or actually where the permanent establishment where the income is being generated? Ongoing process. I think the tax authorities want to focus on the headquarters, just giving you a feeling that these that it is important once you start, or if you want to start MAP proceedings, really look at the legal basis you want to use, because they are not fully interchangeable, and some may apply to your situation better than others. And I think that is the key takeaway here. Next slide, please. One important thing to remember with the EU arbitration, if you make that choice, EU arbitration directive, very formalistic, but also very reliable. So it's more like a litigation procedure, to be honest. It's very detailed, very well thought through. So it is actually, if you're looking for this sort of reliance and actually procedural rights and participation rights for your company, that may be the way to go. Whereas, on the double tax treaty, it's depends on who you're talking about and the competent authorities involved. Next slide, please. So, and just to wrap it up, so consider what your options are, what you're really looking for, what is your strategy. Again, I really like that word. So look, what is your MAP strategy, and then choose the right legal basis. We've summarized a little bit important, or what we consider important factors in this table, and please refer to it if it may help you. Next slide, please, because that's what I actually wanted to talk about, a few case studies. This is actually, the first one is a case which was ruled at a lower court here in Germany, and it refers to these several legal bases which we have here in Europe, and that's what makes it a little bit interesting. So we have 2 subsidiaries, one in France, one in Germany. There's a delivery of goods between them. The parent company is in Luxembourg, which is not really important for the case. So there's a delivery of goods, and as it is, the transfer prices are challenged in audit and being adjusted. The taxpayers seek mutual agreement. A mutual agreement procedure with the competent authorities under the Article 25 of the German-French Double Tax Treaty. And hold on, I'm not done with the facts. And then, and then it turns out that all went through. There's an agreement. There's an obligation actually between Germany and France to reach that agreement. They reach an agreement. They come back to the German GmbH and ask, are you fine with that agreement? That is the procedure as it is in place, at least under Article 25. And the German company says, no, I don't agree. I don't like the outcome, basically, because it wasn't in favor, obviously, of the GmbH in Germany. And then they went back, and that is the funny part here. Then they went back and applied for another mutual agreement procedure under Article 6 of the EU Arbitration Convention. So they didn't like the first outcome, so they said, oh yeah, just do it again under a different legal basis. German competent authority denied it, and they filed action with the tax court. And now, next slide, please. The German tax court then said, well, there's no need for legal protection. You already got what you wanted, because all that is being owed to you is a mutual agreement procedure which will dissolve the double taxation. And you got that, you didn't like it, too bad. You cannot come back on a different legal base, on a legal basis, and file for another mutual agreement procedure. So that is very interesting and shows you that. So choose wisely before you start these proceedings. There are different rules now how to, which one to use in which situation. And in most jurisdictions, at least in this one here in Germany, we have that. But here, you cannot just come back and file for a different one. That may be different if, the first one failed because there's no obligation to reach an agreement. But typically, if you have an agreement, you have to live by it. Next slide, please. And I'm really quick about this one, although it is a very interesting case, a case which we see a lot in practice. And it actually refers to the different competencies of the different tax authorities involved in a transfer pricing, audit, and mutual agreement procedure. So you have the competent authority, which in Germany, which is a federation, is a federal office, right? A federal department. And then you have the state tax offices, which will actually implement whatever is being agreed in this mutual agreement procedure. This is not just in Germany, this is in several countries, and it's important to understand. What happened here is there was a mutual agreement procedure, I think it's Germany and UK, okay, where the price, where they reach an agreement, and then, they come back to Germany, the competent authority comes back, if you want, to the local tax office, which is in charge, of implementing this agreement. And the German tax office says, oh yeah, okay, so you had a transfer price per item of 100. Now you've agreed on 90. So there's a difference of 10, which has actually been paid. We consider this to be what we call a hidden profit distribution, and we will levy capital gains tax on it. So capital gains tax on dividends is just a typical German, under national law, what you would do, also in a hidden profit distribution. So they want the capital gains tax on the difference, which has actually been agreed that it should not be taxed in Germany, right? And that is the point here. And obviously the taxpayers don't like it. And now this is the kicker here. Next slide, please. You cannot do much about it. Obviously, you can complain, you can go to file, but we have looked at this before, not just, also others have looked at this. And it's also in the OECD transfer pricing guidelines. The local tax offices are not necessarily obliged to implement the mutual agreement one by one, meaning that they cannot levy additional taxes like the capital gains tax. Also, it will be quite difficult for the competent authority, in my example, to instruct the local tax office to implement it one by one afterwards, because of federation, right? So different states and the federals, they don't really have the right to instruct each other. So that may be a problem. That's why I find it so interesting and want to bring this case to you. So what you need to do: ask for secondary adjustments when you file this. This is very important. Once you file a mutual agreement procedure, at the very beginning, ask them that they can actually negotiate that. That's in the transfer pricing guidelines. The competent authorities have the power to say, well, we make that adjustment of, in my example, 10 base points, whatever it is. And we agree that no additional taxes will be levied on the balance or anything. that is something you need to consider when filing your mutual agreement application. Something that is missed more often than not, and that's why I wanted to bring that to your attention. Next slide, please. Oh yeah, now I want to hand over to Giles, who will report on MAP versus litigation. Giles, please.
Yes, thank you, Lars. So yeah, I just wanted to touch on, I suppose, just briefly the difference between the MAP procedure and obviously the court litigation. Lars has already touched on some of the procedure in some of the earlier slides, but I suppose the first thing obviously to note is that the mutual agreement procedure is in a sense more straightforward for the taxpayer, because obviously it's the competent authorities who are actually tussling it out between them as to what the correct position is. But you shouldn't forget that obviously you need to make sure that when you make your submissions, make your application for MAP, that you fully explain what the procedure is and where there's a potential breach of the double tax treaty. And we can come on to sort of look at some of those themes in a moment when we look at the experience in the Middle East, which frankly is going to be quite similar to other situations in different jurisdictions as well. So the other point is obviously in terms of the disadvantage, again, as Lars has sort of touched on, there aren't really any procedural rights. So basically you're kind of stuck with the decision that you get, if you get one, out of the mutual agreement procedure. But there are obviously various exclusions which we've identified in relation to criminal conduct, which are obviously on the slide there. Whereas if you look at the legal remedies, so that would obviously be where you would want to challenge the decision in one jurisdiction. It may be possible to argue that the taxing authority has essentially breached the domestic legislation, or at least the domestic legislation should be interpreted consistently with the treaty. There might be an argument there where you could take your case through the domestic litigation. Obviously, in most jurisdictions, you're going to have a fairly lengthy procedure, and the decision will be precedential. So that means it will apply certainly to you as the litigant, but it might also apply to other situations as well. So if you have other group companies who aren't actually the litigant, it might create a precedent for them, or indeed for other taxpayers. One of the potential disadvantages is that the judges aren't necessarily expert, particularly in transfer pricing. It's obviously a highly specialist topic, and therefore it's something that courts and tax courts aren't generally that well equipped to deal with. Although they might look at expert evidence, they do find it quite difficult to grapple with. The procedure can be lengthy, and it certainly in most jurisdictions you're going to look at least 5 years, possibly more, depending on how many levels of appeal you get through. We also, of course, don't have any court fees. I notice we're actually now coming right up to time, so I don't know whether we should continue, but if we go on to the next slide, if there is time, we can just talk very briefly about some of the best practices for tax litigation in the Middle East. I suppose the first thing to note, as with any litigation, is obviously to make sure that you protect your position, make sure that you observe the correct time limits for reviews and or appeals. There might be a process that you need to go to before you actually get to the tax court. Most jurisdictions in the Middle East, particularly, for example, UAE, Saudi, etc., have fairly new and have thrown a lot of money at their tax procedures. So they're quite sophisticated. Quite often they follow sort of Western type legislation. So some of it is quite familiar, but you do have to watch out for some bear traps, particularly around timing and so forth. You might also need to pay the tax in dispute. That's obviously comparatively common, but again, there might be ways of avoiding having to do that. The other thing, just in terms of a practicality, is that, as I say, a lot of these tax authorities and the tax courts have now got fairly sophisticated procedures in terms of electronic portal. So you need to make sure that you've got all of that in place before you actually file your documents with the court. And you need to make sure that the evidence that you are producing is as full as possible. So that's really going back to the points that Carol, Lars and Gianluca made at the beginning, which is making sure that your evidence matches exactly what's happening on the ground, because that will be important in making sure that you have the best possible case. And therefore you need to make sure those are sort of submitted very clearly in writing. You also need to make sure, of course, that it is accurately translated into the local language. So if we move on briefly to the next slide. So if on the other hand, you are going to look at the mutual agreement procedure, you might be doing that in parallel with a court case. So there might be a court case that you'd want to put in to the local jurisdiction in order to protect your position. And obviously you'd need to make sure that the procedure is suspended while the mutual agreement procedure is in place, and that therefore, again, you don't sort of jeopardize the litigation process whilst you're undertaking the mutual agreement procedure. It's also worth bearing in mind that you should try and contact the relevant competent authorities, probably in both or more jurisdictions, to see whether or not it's likely to be accepted before you actually put forward your full application. And again, I think it's really important to make sure that, bearing in mind all of the points that have been made already around evidence, that is a really critical aspect of this process, because it's your chance to advocate your position clearly and succinctly for the competent authorities, because that's really going to be the tool which those competent authorities can use to argue with the other competent authority. And the other point is to make sure that you're sort of fully aware that the process is between the competent authorities, and therefore you have to sort of bear in mind all of the points that Lars made. So those points will apply equally to Middle East mutual agreement procedures, which are quite new in many instances. So they are sort of learning the process, and in a way you can gently educate them as to the process. So I think that's all we've really got time for, but I will now hand back to Carol. But before I do so, I have to tell you the CLE or CPE password, which is CHEESE, that's CHEESE. So handing back to Carol.
Thanks, Giles. Looks like we went over time. We've put in some slides on APAs and ICAPs at the very end. We had a feeling that we were going to run out of time, so it's there for your reference. Thank you all so much for joining us today. Since we're out of time, if there are any questions that you have, please feel free to contact myself or any of my esteemed colleagues, and we'll be happy to answer any questions. Thank you all today, and we'll be ending the CLE CPE. Thank you.